This is the Ration Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So one of the things I wanted to talk about right off the top with you, instead of just introing the episode, is doing a podcast something you'd want your financial advisor to be doing? I think it's a pretty cool question. And I can say this is episode 60, so we've had 30 or so interviews with special guests, and there's been many that have changed and improved how we think.
Absolutely.
And we've come across people that are helping us in our practice we've gotten to know after the fact that we reach out to as subject matter experts.
And recency bias in effect here, so apologize to older guests, but Alexander McQueen that we just had on in our last episode, that has, well, we're in the research phase now, but that we'll see what the outcome is, may have had a fundamental impact on the way that we structure our overall asset allocation, product allocation.
Yeah, we're exploring new tools and changing our framework of thinking around retirement and the use of annuities.
But I never would have put my head into annuities. I read her book because she was coming on the show, and I learned a ton. But it is an interesting question. I'm sure other advisors out there are putting tons of time into research and understanding these different things, but we put a lot of time into researching and understanding these things. Like guest episodes, you're right, subject matter experts, we learn a ton. But just the amount that we dig into stuff for the conversations that we have with each other, it's a real motivation for us to put a lot of time into understanding and researching and being able to talk about a wide range of topics.
Yeah, and trying to get better at communicating some of these concepts because they aren't easy. And as you'll hear in this episode, we talk about valuation theory, where I basically get Ben to talk about valuation theory, which is complicated, but I think you did a good job of bringing it back to showing how science and technology is evolving over the decades, hopefully leading to a better investment experience.
But you know that the piece you just said, Cameron, the communication, that's like for us in our role in dealing with clients. We just had Moira Summers, who was on the podcast a while ago. We were speaking with her last week, and we can have the best advice in the world, the smartest advice in the world, and we can have all the data and all the understanding of what people should do. But if you can't communicate that in a way that people will understand and be able to action, it's completely useless. So that can be like, what is our role? We're not stock picking portfolio managers. We're here to help people make good financial decisions. But how do you do that? It's all about communication. But to communicate, you have to understand on a certain level that you can get other people to understand too. It's pretty interesting stuff. This episode, like Cameron mentioned, we talked about valuation theory. So I'll post links to the papers for sure, but I'll also post a little summary of sort of my take on valuation theory, but I'll also have the equations on there. So if you go to rationreminder.ca, episode 60, you'll be able to see the equations as we're talking about them if you're at a computer, I guess. But that might help because there's a lot of numbers and relationships.
All right, here we go.
Welcome to episode 60 of the Ration Reminder Podcast.
So off the top, I think we should be talking about the question that we're getting the most often lately, which is the obvious recession that's coming.
Yeah, the recession's coming. Haven't you heard?
Well, of course. And why would you want to buy now when the market's going to be lower in a few weeks? So it's pretty much a no-brainer, of course. And if it was that obvious, as I always say, the market would already be there. And frankly, if it's coming up on a discussion in our office, pretty safe to assume that the rest of the market already knows this information.
But I think it's coming up everywhere. It's online. Anywhere you look, people are talking about the recession, but they're not just talking about the recession. They're talking about the impending recession, like this recession that is about to start.
Well, we've been this long in the cycle. So after 10 years, it has to happen. And of course, the yield curve has inverted. That's a dead giveaway.
The challenging thing is that's true. To take it back to reality, that's probably why people are talking about this, is because the U.S. yield curve is inverted, and 9 for 9, the last yield curve inversions in the U.S. have been followed by an economic recession within 14 months.
So yield curve is when short-term rates are higher than long-term rates, in simple terms.
Correct. And the central bank is setting short-term rates, but the market is dictating the longer-term rates with bond prices. And so if the market thinks that a recession is coming, the story goes that people are buying longer bonds, which is pushing their prices up, pushing yields down, causing the yield curve to invert. So it's supposed to be some sort of signal.
Yeah, and I saw one of Trump's economic advisors on the weekend saying, well, long bonds are going up because so much money is coming from around the world viewing the U.S. as a safe market, so driving the prices up, so long-term yields drive down. So he was putting quite a positive spin on the optimism about the U.S.
And then last week we had some market volatility, and so everyone's like, oh, there it is. There's the recession.
Yeah, it came finally, and then it seemed to go away. We're recording this on Monday, the 19th. So Friday, the market was up. Today, it's up again. So maybe it was here for a few days last week.
And the funny thing is that the stock market and economic recessions have not exactly had a strong relationship historically. Ben Carlson, Wealth of Common Sense, did a post on this a while ago now, but he found that the S&P 500 has had 20 bear markets, which he defines as down 20% or worse, and 27 corrections, defined as down 10% but less than 20% since 1928.
So 47 events.
And the average losses saw stocks fall 24%. The drop lasted 228 days from peak to trough on average. And of those 47 double-digit sell-offs, 31 of them occurred outside of a recession and did not happen in the lead up to a recession. So he infers from that 66% of the time, the market has experienced a double-digit drawdown with no recession as the main cause.
Yeah, I mean, we're making light of this, but what we're really making light of is the fact that people think it's so easy to predict when this is going to happen. And I think it's because they connect the news and the stories in the news with wild or perceived to be wild market swings.
Yeah. And there's some interesting data too on, like, what if you did use the yield curve? Because in the US, 9 for 9, it has predicted recessions or preceded recessions. I looked at the data for the financial crisis. So the US yield curve inverted in February 2006. And after that, the S&P 500 posted 14.52% return over the next year.
Amazing. So that's the year before the crisis.
Yeah. The yield curve became upward sloping again in June 2007, which was well in advance of the market's major downturn. So if you tried to time the market on the initial yield curve inversion, you would have missed the big gain. And if you then bought back in when the yield curve went back to normal, you obviously invested right before the big crash. And there's also the global data on yield curve inversions. It's not as obvious as the US data. We have the data on Australia, Germany, Japan, UK, and the US back to 1985. There have been 14 yield curve inversions. After 10 of those inversions, market returns were positive for 3 years in the local stock market. So it's like, number one, we don't know if there's a recession coming. Number two, the yield curve inverting does not necessarily predict a recession. And number three, even if it does, it doesn't help you make market timing decisions.
Right, because it can happen outside of those inversions anyways.
Yeah. And there's another data point that I didn't have in my notes, but most of the time, if not all of the time, we don't know that the recession has happened until it's either well on its way or it's over. Like, you don't really know if it was a recession until after the fact. So the whole talk about the recession's coming and what should I be doing and are we in a recession, it's ridiculous.
I think back to the interview we had with Dave Getch, talking about why not just embrace variable returns and volatility and just get used to living with it and make sure you have a portfolio that's appropriate to your tolerance.
Yeah, it's just such a waste of time talking about the recession.
Anyways, that was bonus topic of the day. So now we're on to our current topic. So you want to talk about some new asset allocation ETFs that have come out?
Nothing too crazy, but iShares came out with a couple more products. So they've got, I think, the same lineup as Vanguard now. So from 40 stocks, 60 bonds, right out to 100% stocks. There's now a full suite of asset allocation ETFs on both sides. They might actually even go more conservative than 40 stocks. I can't remember.
And there's 30 in total, right? With about $4 billion of assets in Canada.
30 asset allocation ETFs, yeah. So that's now iShares, Vanguard, BMO, Horizons.
CI's got a new one that came out, which is actively managed global asset allocation fund, ETF, I should say. MER is at 60 basis points. And I pulled out a table showing just to see, well, how much sales are going into these funds, how much new assets are going. So we peeled off the top 20 and the top 20 ETFs with the greatest redemptions. And pretty amazing how 8 of 20 of the top selling ETFs for July of this year were from Bank of Montreal, bringing in over $1 billion of net assets.
They've been pretty focused ever since ETFs started to become a real market in Canada. BMO's been hyper-focused on being one of the leaders, and they've done a good job.
They've done a very good job, and it's amazing how Vanguard is right down to position 19, 18, and 12. Even 12 spot was a Canadian bond ETF that brought in $83 million. It's incredible to me that with their great one-decision portfolios, that's their number one seller in Canada in July.
Well, bonds have done so well this year, and maybe that's why.
Well, the number one selling fund is the BMO Long Federal Bond Index ETF that brought in $374 million, which is a 55% increase in assets in the month from purchases.
Yeah, it's pretty crazy. And that ties into our other current topic for the day, which is Wealthsimple changing their model portfolios. And one of the securities that they added was that long bond ETF.
Duration of 16.
Yeah, it's long.
Year-to-date returns of 9.1%.
Yeah, you got to wonder if those inflows are because of Wealthsimple making that change. It has to be. Or just because bond returns have been so hot, but it has to be from Wealthsimple. You don't have inflows like that just based on recent returns.
The only asset allocation fund on the list that made the top 20 was Vanguard's balanced ETF, the VBAL.
Yeah, it's fascinating.
$52 million, which is in the Canadian marketplace is like a drop in the bucket. for such a great product. Anyways, you want to talk about the current topic number 2 today, the Wealthsimple portfolio changes.
So they changed their portfolios, which is fine. And they did a pretty insightful white paper on why they made the changes.
Very well done paper. Easy to read, no jargon.
Yeah, they did a good job. But detailed too, like very detailed. It goes as deep as anybody would want to go. Not that I agree with it, and we're going to talk not with the changes, which we're going to talk about. The big changes that Wealthsimple did was they added minimum volatility stocks, longer duration bonds, inflation-linked bonds, and they made it more geographically diversified. And the geographical diversification was really, I think, adding emerging markets, and they really stripped down the Canadian equities. So instead of being 1/3 in Canada, I think for the equity portion, it's about 12.5% now.
Yep.
So they really stripped down the Canadian home bias, which is it's fine. I have no problem with that.
Yeah, we totally agree with the principles they outlined in that paper. Risk drives returns, diversification increases risk-adjusted returns, and outperforming a diversified, low-cost, passive portfolio is extremely hard. So those 3 principles we're totally in alignment with.
And this is Wealthsimple saying these are our portfolio management principles that guide how we designed our portfolios. Yeah, like you said, Cameron, those are arguably the same as our portfolio management principles. Now the real question is, are they being true to those principles, which we're going to get into. So for Wealthsimple's fixed income allocation, they increased exposure to longer duration bonds. And this is Wealthsimple's words. So increased exposure to longer duration bonds, which increased their risk contribution to balance out equities. Added inflation protected bonds to better protect against inflation. And then the last one is that they've reduced or eliminated exposure to corporate credit to improve performance in recessions. And again, that was Wealthsimple's words, not mine.
Now cue the factor critique.
Well, so there are 2 known risk factors in fixed income, term and credit. So you hold longer maturity bonds, you have higher expected returns. You hold lower credit bonds, you have higher expected returns. And Wealthsimple in their changes, they've eliminated, as they stated, reduced or eliminated exposure to corporate credit. So they've eliminated exposure to one of the known factors. That's fine. I mean, it's a decision. It is what it is. But it is an independent risk factor.
Because they wanted to spend more risk dollars on the equity side.
Well, the way that they explained it is that with corporate bonds, you're getting a little bit more correlation with equities, which is true. That is true, but that doesn't mean credit is not an independent source of risk. So I don't know if I'd remove it. Like we have an intentional credit exposure in our fixed income. But anyway, that's a portfolio management decision. That's fine. So with term, the challenge is because they're now going all in on term. They've said for fixed income, we're not credit anymore. We're not going to take credit risk. We're going to take just term risk, but they're really loading up on term risk. But the challenge with term is that in terms of risk-adjusted returns, there's a diminishing return the longer you go out on the term spectrum.
That's right. Per unit of risk, you're not getting as much unit of return.
Correct. So loading up on long-term bonds, yes, you're increasing your expected returns, but per unit of risk, you're not getting enough bang for your buck to justify the decision. So I don't know if I would have done the same thing, but that's fine. Now for the inflation protection, I thought this was really interesting when I read the report, because I had in my head, okay, well, in Canada, the inflation protected bonds, they're not super liquid. The market's not that big. So I'm, kind of curious.
Super long duration too, I believe.
Yeah. So I was kind of curious to see how they're implementing, and they acknowledged all of this. So I'm reading the report thinking, okay, so I wonder how they addressed it. Well, they're using US tips, which is for a Canadian resident, I would say, and maybe I'm not the expert here, I don't know, but I would say that using US tips for inflation protection as a Canadian resident with Canadian expenses doesn't make a whole lot of sense.
And is it currency hedged?
If it's not, that's a big mistake, in my opinion. Having globally diversified fixed income without the currency hedging, you're going to have equity-like volatility due to currency with fixed income expected returns if you're not hedging global fixed income exposure. So if this is that, if they're not hedging, and it wasn't clear from the report if they're hedging or not. If they're not, though, that's an interesting decision. But even just pegging to US inflation and saying that's inflation protection for a Canadian, I guess that's betting on the correlation between Canadian and US inflation. Maybe that correlation's high. Maybe it will continue to be high. I don't know. Anyway, for us, we don't do any real return bonds in our portfolios. And one of the reasons is the available securities in Canada aren't great. I mean, what do you think? Would you go to the US to get inflation protection for a Canadian portfolio?
I don't think so, no. We always hedge our foreign bond exposure.
Well, that's the currency. I don't know. Anyway.
So let's shift over to the equity side. So they shifted part of the equity allocations to minimum volatility, which we talked about recently on the podcast. And then they reduced their Canadian bias. So the min vol is a very attractive name, of course.
Yeah. And I mean, so this is where the principles to me were a little bit disjointed relative to the words in the report. And the min vol is one of the reasons, but they say that they're reducing equity risk in the portfolio. But we're talking about the principles being wanting to target risk drives returns. So we want to target risks. Now we're talking about eliminating equity risk. To, by the way, add additional term risk, which has diminishing returns the longer you go out. Anyway, so it didn't make a whole lot of sense. But adding low volatility was an interesting decision. And Wealthsimple talks about this in the report. The low volatility anomaly, because it is anomalous, it has now been removed as an anomaly. As soon as Fama and French came out with the 5-factor model, low volatility is completely explained by exposure to profitability, investment, and value. But when we talked about this in the podcast a while ago, we were also talking about how there's time-varying factor exposure. So if you have low vol, sometimes you're going to get more value, sometimes you're going to get more profitability, and there's no real way to know what you're going to get. So you're going to get this unreliable outcome.
And their portfolios don't have fixed allocations to size and value.
Right. This is the thing that's crazy to me. Like my head's exploding. They're talking about risk drives returns. I'm like, yes, risk does drive returns. And they're talking about adding min vol, which is like you're getting naive exposure to risk factors.
And not persistent exposure to those factors.
But like if you understand that risk drives returns, why are you not targeting exposure to known risk factors? It doesn't make any sense to me at all. Anyway, so they did acknowledge that in their paper that low vol is going to give you some factor exposure, but they also acknowledge that there are some other explanations for why low vol has had good past performance. But anyway, it was just a weird decision in my opinion. And even beyond adding in additional risk factors, just to get the benefits of low volatility, Robert Novi-Marx did a paper, because he's the guy that discovered the profitability premium, but he did a paper explaining that the benefits of low vol are almost completely explained, or low beta are almost completely explained by the fact that using a low vol filter eliminates small cap growth stocks with low profitability, which AQR refers to as junk. But then Novi-Marx says, okay, well, if you want to eliminate junk, just eliminate junk. You get all the benefits of low vol without the reduction in diversification.
Exactly.
Which again goes against one of Wealthsimple's principles that diversification is a good thing.
And the ETF that they're using is a much less diversified portfolio, right? They're using the iShares MSCI MinVol ETF.
Yeah, so there were two. They did most of the allocation, the one you just mentioned. They also had emerging markets, low vol. But I looked at this ETF, and this is a global equity ETF, but MinVol, low volatility, and it's got 444 holdings. And if you compare that to a true just market cap weight global ETF, like the Vanguard Total World Stock ETF, it's got 8,202 holdings. So, I mean, talk about concentration for a global portfolio, which decreases the reliability of your outcome. And then the other issue, so this is Robert Novi-Marx's whole point was to get the benefits of low vol, you can just kill small cap growth, low profitability. And he's saying, well, if you're not doing that, if you're using low vol, you're going to get concentration, which we just talked about, but you're also going to get more turnover. You're going to get more securities having to be bought and sold in the portfolio each year. So if we look at the iShares Edge MSCI MinVol ETF, it turns over, I looked at the annual report, about 24% of its holdings per year. And I compared that to VT, the Vanguard Total World Stock, which turns over about 10%. So you're getting a ton more turnover by targeting low vol. Anyway, so I get the intention, but this is not how I would execute a portfolio change, I guess.
So on to our portfolio topic. So you want to talk about valuation theory.
It's way more exciting than it sounds.
It's way more exciting. So I'm going to try to interject and make sure it's coming across clear to our listeners. So tell us, why do you want to talk? Like, where do you want to go with this?
Well, we've talked about factor investing in the past quite a bit. And we've talked about the empirical component of the factors. We've talked about the empirical validation of the factors and how that analysis has been done and the sort of statistical aspect, which is great and interesting. But we've always made references to the theoretical underpinning and why we believe in this stuff. But we never really talked about the theoretical underpinning. And I was reading through some of the Fama French papers where they really established that theoretical underpinning. And I thought it was the most interesting thing ever.
Yes, this is what Ben does.
Yeah, that's true. It is.
I know you've always got a point when you come up with these topics. This is a pretty meaty topic.
Yeah, well, okay. So let's just jump into it. So when you buy a stock, you're buying the future profits of a company.
Got it.
That's pretty basic stuff. So the price of a stock depends on the expectations for future profits and how risky those profits are perceived to be. Because future profits, you don't have those today, which means you've got to discount those cash flows to their present value. And when you're discounting cash flows, if anyone's familiar with basic finance, when you're discounting cash flows, the riskier they are, the higher the discount rate you're going to use.
Which is the expected return, the premium, the return that you're commanding to own that security.
Right. And so, I mean, the way that you can think about the premium is that if we have two stocks with identical future profits, so if you and I are both looking at two different stocks with the exact same future profits, but the stock I'm looking at is way riskier. The stock you're looking at is safer as perceived by us. I'm going to be willing to pay less for that same stream of future profits because it's riskier, which means I've got a higher discount rate. But it also means that because I'm paying less for the same future profits that you're buying from a different company, I'm paying less, which means if I actually get those future profits, I'm going to benefit more.
And in that scenario, yours would be considered more of a value stock than mine.
In that scenario, yes. If I'm buying the same future profits for less, yes, it's more of a relatively a value stock compared to yours. So this was all captured mathematically in 1959, I think, by the dividend discount model, which just said mathematically that the market value of a company is the sum of its expected future dividends discounted to their present value at some discount rate. So then Miller and Modigliani came out in 1961. I've got this reputation now as being like anti-dividend, or although some people would just say there's a reputation as like of actually understanding the economics of stock returns, but depends who you ask. So Miller and Modigliani came out in 1961 and they showed dividend irrelevance. And the way that dividend irrelevance can be applied to portfolio valuation or the dividend discount model is that instead of using expected dividends in the numerator in the top of the equation, you can use expected earnings minus changes in book value. So if you think about that, using earnings minus changes in book value is the same thing as dividends.
Because you've used up money you would have paid in a dividend to invest in the company and stuff, which would have changed the book value.
Correct. So if book value is increasing, that's an investment in the company.
So you've used your cash to the investment as opposed to pay it as a dividend.
Correct. And the difference between earnings and changes in book value, anything that is left over, must have been distributed as a dividend. The next thing that happened in this research, and this is where Fama and French kind of kicked in. So they took all this stuff that had been done in the past, dividend discount model in the Miller-Modigliani.
But this is decades later they did this work.
Yep. So this is 2006. So dividend discount model was pretty old, but it was also validated by empirical research. And then dividend irrelevance, again, it was relatively old research, but it has been continuously validated by empirical data. And then in 2006, Fama and French, and it is amazing that it took that long for someone to do this, but in 2006, Fama and French took this sort of updated dividend discount model, and they just said, well, look at this. If we scale it by book equity, so that means market price over book equity, is equal to the dividend discount model with earnings and changes in book value over book value. If we make that equality, then it demonstrates mathematically all of the premiums that Fama and French ended up including in their 5-factor model.
Okay, so this is the important part.
Yeah. And the reason that this was interesting so far is because Fama and French were just making this up out of thin air. They were using 2 pieces of well-established research, theoretical research, but they were also using a ton of empirical data. So all of the relationships that I'm going to describe in a second, it wasn't just Fama and French saying, look, this theoretically should be true. They were saying this theory matches up with all of the empirical data. And in their paper, in Fama and French paper, they cite, I don't know, it must be 30 different peer-reviewed papers showing that all these relationships hold true. So in this equation, and I know we're talking with words and you can't see the equation that I'm talking about, but if you think about it, it's market price over book value equals expected earnings minus changes in book value over 1 plus R to the T, which is the discounted future profits over book value. Now in that equation, if we hold everything constant except for the price of the stock and the expected return, then we see mathematically that a lower price relative to book value must imply a higher expected return. So this is just a mathematical.
Yeah, that's not opinion. That's just math.
Correct. Mathematics. And then if we hold everything constant except for expected future earnings and the expected return, we see that higher expected earnings must imply a higher expected return. That one's really tricky because that's a profitability premium. So when someone says a stock that is more profitable must have a higher expected return, that's counterintuitive in the context of a risk premium. Why would a more profitable stock have a higher expected return if we're using the risk framework for return premiums?
Because more profitable, people would think, well, that's a safer company if it's more profitable. Not in this equation.
This is the thing. So this is the amazing thing about the valuation equation that Fama and French developed, is that if you hold valuation constant, so if you hold relative price constant, that's the price relative to the book value of equity. If you hold that constant for 2 companies, and one of those 2 companies is more profitable, the company that is more profitable must have a higher discount rate applied to its future cash flows by the market.
Right.
Because it has the same price relative to the book value of this other company that we're comparing it to.
Which stands up to the risk theory is the justification for these premiums.
Correct.
The risk story.
Correct. So now we have a theoretical explanation for the profitability premium. And then the last one is that if we hold everything in this equation constant except for expected changes in book equity, which is an investment, which is the fifth premium in the 5-factor model, and expected return, we see that lower expected investment must indicate a higher expected return. Again, this is just a mathematical relationship in the equation, which we can post on the website because maybe it's easier for people to think through when they can actually see the equation. So interesting, but the thing that's amazing is that these individual relationships, like the higher returns of value stocks and higher returns of stocks that invest conservatively, higher returns of stocks that are profitable, all of that had been documented in peer-reviewed research.
Many years before this.
Correct. And leading up to this. And Fama and French are just saying, if we look at this valuation equation, we would expect that all of these relationships don't exist in isolation. But if we actually control for a couple of the variables, we should find more extreme premiums. So if you find the deepest value, most profitable stocks, you'd expect an increasingly high expected return. And that's, again, just based on the mathematics. So that's cool. That's interesting. But then the amazing part is that it took 9 more years. So in 2015, Fama and French finally came out with their 5-factor model. And the reason that it took so long, I think, is that when they wrote the paper in 2006, there was not a good proxy for profitability and investment. So those are the last 2 factors in the 5-factor model. But in 2012 and 2013, peer-reviewed papers came out identifying good proxies, and then it didn't take long for Fama and French to incorporate those into a 5-factor model. So now we're back to the empirical side. But the amazing thing is that Fama and French went from the theoretical research to show these are the factors that should explain differences in returns. And then once they had all of the tools from the empirical research, they were able to build the 5-factor model.
Super interesting. It's basically a story of technology and science going back and forth over 50 years.
Right.
Amazing.
It really is. It really is amazing. But this, to me, I got that there was a theoretical underpinning. I got that, but probably at a surface level. But when I started reading this, it was really the 2006 paper. I started to realize, like, geez, this is it's a really strong theoretical foundation. And so questioning if people want to say, well, you should use a different factor model, you should be using momentum, you should be using quality, whatever you want to say, it's really hard to make those arguments, to me anyway, when you understand how strong the theoretical background is. But then the amazing thing about it is that we have the strong theoretical background. Once they had the 5-factor model built, they can now go and start testing it empirically. And this is where it gets like mind-blowingly interesting, is because they can now take the 5-factor model and they can test it against cases where the 3-factor model didn't work. So if there was an anomaly like low volatility, which we just talked about, that the 3-factor model that Fama and French published in 1992, if there's an anomaly that model could not explain, you would expect, if the valuation theory is true, you would expect that the 5-factor model would be able to explain those differences. And it did. It does. And so they've looked at all sorts of different anomalies since then. And consistently, the 5-factor model explains differences in returns. So it's like this strong theoretical foundation, but then you add on the fact that when you take the empirical data using that theoretical foundation, it just strengthens the position of the theory, I guess.
So I think you pulled it off. I think people get it.
Well, we'll see.
Fire in any questions on the website, and love to have some engagement on this. So move on to the next topic, planning topic, one that gets us both fired up. So the spending rules for FIRE. So financially independent, retire early. I know this is a bit of a bugaboo for you. Perhaps you chilled on it a bit lately because there's been so much talk in the media and on Twitter about different people getting into the FIRE movement and becoming bloggers and writers and all kinds of different things.
Well, I talked to someone not too long ago. I talked to someone who wants to retire early, and they're an intelligent person, and I always have good conversations with them. And so they say they want to retire early. And I just ask them candidly, like, why? Like, what do you want to do? I think that retire early is a really bad name for this movement. The way that I'm starting to understand is that people want to do things that they love as opposed to maybe a career that they don't love, but they want to do the things that they love without sacrificing lifestyle, which means they potentially need to have income from some investment to fund any shortfall.
A lot of the ones I've looked into have reasonably modest lifestyles. A lot of people don't have enormous amounts of money to afford a lavish lifestyle, but that they're totally okay with that. They figured out what lifestyle makes them happy.
Yeah. So I don't think it's a matter of like, I want to retire and do nothing. It's like, I have an idea of some stuff that I want to do and I need the capital to fund that. So I'm kind of coming around to that, I guess, but I do have a big problem with a couple components of the FIRE movement.
The rule of thumb around the 4% rule, safe withdrawal rate. And as Alexandra told us last week, there's so many rules of thumb that I think it's safe to say drive her crazy that people use, and 4% is certainly one of them.
4% rule is completely ridiculous.
especially if it's a young age.
And I do think that the prominent FIRE people, all of them, I mean, I guess it's selection bias. All the ones that we know about are the ones that are public about it. But there seem to be a lot of people who are publishing blog posts and books about how they've become financially independent, but they're not necessarily talking about how they're using the income from their blogging or book writing or whatever else they're doing.
I think many of them have a lot of side income from that. I don't know if there's any data on that.
I don't know. Anyway, so 4% rule, we've talked about it in the past, but it's worth mentioning again, because I think this is one that's really, really dangerous. The 4% rule was developed by a financial planner named William Bengen. But when he developed the 4% rule, he did historical testing to find the worst 30-year period in U.S. market history and what was the sustainable spending rate over that 30-year period. I
can hear our listeners now scratching their head. Oh yeah, I remember you guys talked about this a few months ago.
Yeah. And so that was the 4%. That was where 4% came from. For early retirees, like we're talking about FIRE, financial independence, retire early, the big issue with the 4% rule is that it was designed for a 30-year retirement. So if we're talking about a 50-year retirement or a 60-year retirement, the 4% rule doesn't work. But it goes even deeper than that. U.S. market data, we know now, looking back, that the U.S. market's been the best performing global stock market. If you instead use global stock market data to perform the same analysis, you would have come up with a 3.5% spending rule.
And by the way, where are fees in that number?
Yeah, fees aren't there.
No one's ever certain, are fees in or fees not?
Fees are not
factor premiums in there, factor premiums not.
Fees are not in, factor premiums are not in.
Taxes?
Taxes are not in. Withholding taxes are not in. So I'm not a fan of the 4% rule.
There's still a ton of people that think 4% is too low. A lot of people, I'm sure, in their mind think, well, I can get whatever, 6% of my portfolio, therefore I can spend that.
Oh, yeah.
They don't even think about the replacement for inflation.
I had someone on my YouTube channel comment recently that they use options. They were very aggressive. Like they were not a nice person on the internet, but they were saying how they use options to increase their stock returns. And if you're earning anything less than 7% on average, you're basically an idiot. And so 4% rule, yeah, way too low in their opinion. One of the challenges with testing something like the 4% rule for longer retirements is that there's not enough data. Like how many rolling 60-year periods are there historically? Not enough.
Not enough to be significant,
yeah,
I don't think.
Not enough to be meaningful. But one of the ways you can test it is with Monte Carlo. So we did that a while ago. We built a Monte Carlo model. And it's actually interesting. When you use the Monte Carlo to figure out what the 4% rule should be, it ends up being 3.5% for a 30-year retirement using the Monte Carlo simulation, which is the same as it would have been using global data, the way the original 4% rule analysis was done. If you extend that to 50 years, the safe withdrawal rate drops to 2.4%.
And again, there's no fees in that.
Correct. But I also think 2.4% is pretty low. That may seem confusing because I'm talking about how the 4% rule is too high. But I think that the real trick, and if you read like Mr. Money Mustache, yes, he talks about using the 4% rule, but he also talks about being flexible with spending. He also talks about having side incomes. He also talks about different ways to deal with inflation.
Flexibility in spending is a conversation we've had a lot with people planning their retirement lately. Like find out what is that zone that covers all your basic needs. And we know behaviorally, if the market tanks 1 year, you're not going to be doing your big, expensive round-the-world cruise.
And I think it can be systematic too. Like there's a bunch out there, a bunch of different variable spending rules out there. But I think, like you said, Cameron, you can set a floor and then ratchet up if markets are good. But that means setting a very conservative floor to start.
But most people's lifestyle is a pretty basic floor. And it's all the other stuff so that instead of taking out monthly out of your account, you could do in lump sums as the trips come up or the gifts to your kids or whatever your spending desires might be.
You can also have guardrails. So you might start with the 3% withdrawal rate in the first year and set a guardrail at 5% and a guardrail at 2%. So if your inflation adjusted spending in a future year rises above 5% of the remaining portfolio, you would adjust your spending back down. Or if it drops below 2%, you would adjust your spending back up. I think that those rules are fairly simple, but implementing them realistically, that takes a serious amount of discipline and a spreadsheet. But flexibility, when you look at long-term simulated outcomes, like using Monte Carlo, if we're talking about a 50-year retirement, even though the withdrawal rate's low at 2.4%, like in our example, the average ending assets are going to be crazy high, like tens of millions of dollars or something like that on average. And you're planning for that worst case outcome, which is why you've got to spend so little. And that sucks. Like if you die with $50 million and you only spent 2.4% of your portfolio each year, like that
that's
sucks.
Why you have to be on top of this and revisit it all the time.
Yes. And that comes down to the efficiency, spending efficiency, which we talked a little bit about with Alexandra. And I think that we've been talking about this a lot since we had Alexandra on, but I think using single premium annuities and deferred annuities, that can be a really interesting way to increase the efficiency of spending. But flexibility is also a really good way to increase the efficiency. So if you can be flexible with spending, you're going to be able to use more of your money while you're alive without really increasing the probability of running out of money while you're alive. But you'll spend more as opposed to having a huge pot left over at the end. So anyway, 4% rule, it's not something that you should be relying on in any form as an early retiree.
Yeah, you'd want to plan your lifestyle on a lower percentage.
A lower percentage and flexibility. Like that's the other thing too, is that if you're retiring when you're 30 or 35, you can go back to work. Maybe. That gets tricky too, because if your skills start to diminish, like if you're in tech and 5 years later, everything's changed, maybe you can't go back and use your human capital. So that depends on your skill set and how sharp you stay. But that plays into flexibility too.
Okay, so we're running long on time. Quickly get to the bad advice of the week.
Was this recent or was this an older video?
I don't know. It shows up. I searched Dave Ramsey once, as you know, a few weeks ago, and he's a pretty big time personal financial guy. He's got his own show and he's got his own podcast. Huge ratings. I think he's number 8 in Canada financial podcast. So now it shows up on my YouTube feed all the time. So one video showed up last week and I give him credit because he's very good at getting people engaged in savings, and the amount you save matters more than your return. So I agree with a lot of those principles. So we had a Jeff from Phoenix called in on this one video I saw and asked about the PBS documentary, The Retirement Gamble. It's from the show Frontline on PBS. I don't know if you've seen that. It's a phenomenal. People should go watch it. It's a phenomenal show.
We can link it in the show notes. Do you have the episode link?
I've got the link here, so we'll link it in the notes. Anyways, so Jeff from Phoenix asked about the impact of fees on a portfolio and that the documentary advised that investors should invest in a, quotations, market index fund. So his question was, what is that and what is your opinion? Anyways, so Dave Ramsey says a lot of great things, but here's where, in my opinion, it goes south pretty fast. And maybe I'll be lucky like Ellen Roseman and he'll block me on Twitter. Anyway, so his response was this. So the top 500 companies in the NYSE makes up the S&P 500. Well, that's not
wrong.
Technically right. And he says, or you can go and get small caps on the Chicago Exchange. But he said the S&P 500 will not do any better, not do any worse than the market. And he said there's plenty of mutual funds that outperform the market.
It's true.
It's true, absolutely true. But who can find them ahead of time? But here's where he went on a bit of a rant. So the problem, he said, with the PBS special is that the problem is not the fees. It is the fact that people are not putting enough freaking money into retirement. So that is true. People's savings rates are not high enough. We're in alignment here. He continues, all of these guys that start ripping on fees are from a liberal political perspective of figuring out what is wrong with America today and that capitalism is something bad. They've got this as an undercurrent. You're never allowed to charge a fee for anything in their minds. It is the undercurrent and it is PBS. So we know that's there. The research indicates that getting people to save is a primary thing you do first. The second thing is rate of return. The last thing as an indicator is fees. Wow. So yeah, I agree. People should save more. He went on to describe the 4 types of funds, which is he's got a wacky way of sorting funds. And he talks a lot about behavior, and bad behavior matters a lot. But boy, how do you completely don't understand the underpinnings of why indexing makes sense and why capitalism leads that to happen? Doesn't have advice based on science. Picks funds. I don't know how you manage the managers and keep track of the managers as they switch around.
For how large his audience is, it's staggering the type of information that he's providing. There are a couple of posts that I've seen on Reddit from a while ago where I've even had it on my own YouTube channel where people have said in comments, wow, like I've only ever gotten investing advice from Dave Ramsey. This is so much different. And it's like, man, just on this topic, something that I've found really interesting is I've seen a couple of Reddit posts recently where people have shared my videos, and a lot of the discussion around the video has been stuff like, this guy that's making these videos, he's actually an expert. I don't know if I'd call myself an expert, but like someone with credentials and background who's citing academic research. And the fact that on YouTube that is an outlier, because most of it is just people talking about stuff that they think, like opinion, I guess. But it's amazing to me that somebody with an educational background in a field who's citing academic research is an outlier. And Dave Ramsey falls right into that, where he's not those things, but he's got a massive following.
For example, here's something that you would never say that was in this video. If your expenses are 1% higher, but you came out 4% ahead, the return is your primary measure. The last thing I look at is expenses.
Oh, you got to read the last line there. That's the reality, not the theory. Makes my head explode.
Well, yeah. I don't know how you ignore. You can build beautifully diversified portfolios with tilts towards academic factors, for pennies compared to an average mutual fund, why would you not want to do that and likely have a better investment experience because you're not worried about managers switching and changing? But
we hear this all the time. We hear this all the time where people don't want to look at the evidence. They don't want to look at the theory. And you'll hear things like, well, that makes sense in theory, but in real life, I bought Disney stock and made a bunch of money. That's real life. It's like, man, that's not how it works. That's not how evidence works.
And are we from a liberal political perspective?
I don't know.
That's it?
Yeah, that's it for today.
Thanks for listening. Have a great week.